clicking the buttons.
I turned it off.
All right, we are live on Facebook. Yes. We'll cut out all the troubleshooting. So just a recap. I'm Tanisha. I'm with Brick by Brick Real Estate. We have Megan here.
Hello.
We have Brian. Hello, Brian.
Hello.
And last week we went over rent versus own. Not last week, last month. And we went over how to decide whether it makes sense to keep renting or buying in the current market. If you haven't seen it, go back and watch it. We'll have, what do you call them? Printouts? What are those things? PDFs?
PDFs.
Images that break down what they are. So we'll do the same thing today. So today we're kind of taking it a step further. So last month we ended on, okay, if I want to do this, how do I move forward? What's affordable? What works for my situation? I know we had questions come in as far as like, how does this apply to me? And so that's kind of what we're jumping in today on is affordability. And so I'm going to go ahead and switch things over to Brian. And then we have Megan here. She's going to be watching our chats. So if you have any questions, please message in. And
we are able to create scenarios specific to you. So if you have a question, you want to jump in and say, hey, this is where I'm at, we can totally run that scenario for you live right here.
No
Okay,
pressure.
very good. I'm going to share my screen and we will. There we go.
The tongue helps. You're sticking the tongue out. You know,
It means I'm concentrating. Okay, can you see? You see it? We're good?
So I can see it, but I can only see mortgage payment breakdown. I can't see the whole sheet at once.
Let's see. Why is it not doing that? Let's see. Share. New share.
Oh, there we go. Okay, now
There.
I see the affordability calculator. We're live on the website.
Okay, good. That's what we want.
All right.
Yes.
So
Okay.
walk us through what we're looking at here, Brian.
Okay, so well, the question of affordability, it's got two issues there. So one of them, when people say, "Hey, Brian, what can I afford?" I usually say, "Well, what do you think you can afford?" Because affordability is more of what is more comfortable. So what kind of payment do you feel comfortable with based on your current budget? What kind of car loans do you have? What future obligations do you have coming up? What kind of future money you have coming in? And we'll discuss all that. That's more of an affordability thing. Now, from a loan officer standpoint, we look at it and say, okay, I can tell you what you qualify for as well. And that's really what this affordability calculator is. It's more of what you qualify for, kind of intertwined with what you feel comfortable with. And here's how we do it. We essentially say we look at your monthly income, your annual income, monthly income, and we look at current market conditions generally as far as what interest rates are and that type of thing. We also look at how much your down payment is. So if you look at the four things, we have annual income, interest rate, length of loan, 30-year loan is most common, and your down payment, what you have available. So we kind of throw that in here and we look down and we say, all right, depending on your comfort. Yeah.
We jump down too far. I want to address this because I feel like there's so many loan calculators that exist online that you can go into, and they all default to like 20% down. And even in this case, we have 20,000 down for the down payment option. Can you talk to us a little bit about kind of what options are, especially from like a first-time home buyer perspective of, okay, does that mean if I don't have a down payment, I'm dead in the water, or what are my options? Because I know one of my biggest misconceptions that I'm talking to people with is you don't have to have a huge down payment. I know we've had a conversation in the past statistically of how many first-time home buyers actually have 20%. And I think we were like 3 or 5%, something close to that, right? Of that situation. So I want to be able to address this from a first-time home buyer to maybe someone who's, yes, reselling their home, they have equity in it, they can roll it to a down payment, but both sides of the table. So talk me through the opposite side of if we don't have a down payment, what does that look like?
Great. Okay. So let's start with somebody who has no money down, right? And there's your zero down. And there are a lot of programs out there that are really tailored for that. There's a Utah Housing, which is a kind of a quasi-government, kind of a grant program almost. And what they allow is zero down, and it's pretty good. We do them all the time, very common, and they work out pretty well. There's also the rural housing loans. There's a good list of those that we can use depending on each particular person's qualifications. So if we take a zero down payment option, version, let's say, and let's say your household income is, let's say, $80,000, right? The way we look at it from a qualifying standpoint is we say, all right, you can have a certain percentage of your monthly income that can be all of your debt payments combined.
And that's your debt to income ratio, correct?
That's the debt ratio, right? Debt to income ratio. And that is the sum of, you take your proposed housing payment, what your housing payment's going to be, and what your car payments, student loan payments, any other credit card payments, that kind of thing. What other debts you have. Now, debts do not include, we don't care about your utilities, your cell phone bill, your auto insurance. We don't care about any of that stuff. All we care about is debts that you owe money on, right? Anything you owe money on.
Like taking a step back, this is going over what you can afford, not necessarily what you should buy. Because I know when I'm having conversations with clients, it's like, just because you afford this amount doesn't mean that it's comfortable. So you saying that it's not taking into consideration those payments or those expenses, is that why someone's able to afford a lot more? It's like, okay, if you stop eating and live inside of your house, this is what you can, buy, but you're literally eating your house.
Correct, exactly right. And the theory, and a lot of people, it's interesting, some people have different definitions in their own personal life, what they feel like they can afford. So if somebody eats rice and beans every day, right, the cheap food, they say, well, we can afford a little bit more. But a lot of other people say, you know what, I don't want to spend half my income on a house payment because I'm going to be house poor.
Right.
And I'm going to end up with, what you're saying, Tanisha, is you're just going to end up, not living life. You're just going to be just kind of, it's paying your house payment all for 30 years. So that's really more of an individual type of thing. And there's extremes on both ends. And normally, generally speaking, we're kind of in the middle with most people. And I think that's a good space to be. You don't want to be, some people are maxed out. Some people aren't. Now, there's another situation, we see this quite a bit too, where you may have one of the spouses has kind of a part-time job or seasonal work that we're not able to use as qualifying income, and they feel like they can afford it. They have income we can't use, and then that's a different situation. Or maybe there's some inheritance money coming in, or something like that.
It's kind of one-off exception. So I have a question too. When I bought the house that we're living in now, it was a new build. And we felt like we were at that max point, but we wanted it so badly. We're like, we'll make it work, right?
That's right.
But what we didn't realize is the market helped so much, in the sense of we had 9 months to build. And by the time we moved into the house, like we had gained so much equity, or kind of like, how much can you rely, or in this market specifically, I know we have COVID, we have so much going on, but like, how much does that play a role or factor in what your affordability is into the future, as you're gaining the value of what a home actually is doing for you financially?
Yeah, that's a great question. In fact, and you got to be a little careful with the assumptions. But if you look at appreciation in the future, we're kind of guessing. We have some really good educated guesses. Obviously for the last few years, we've been killing it in the Utah markets. It's been very, very healthy. You've seen values of homes, especially in your area, Tanisha, have gone up kind of almost radically, right?
Super absurd.
It's crazy. It's insane.
Bluffdale, for anyone that doesn't know which area we're in.
Yes.
Yeah, Bluffdale. I can't figure it out. Anyway, but so the neat thing is like, Tanisha, in your case, you made an offer and you locked in a price 9 months early, right? So it takes 9 months, about 8 months, something like that, to build the house. And in that 9 months, I don't remember how much it went up. It went up significantly. Now,
a lot.
but the direct answer to your question is, how does that help you when you bought your house? On the purchase, it doesn't really help you, because, immediately. In other words, if you lock in your price for $350,000, let's say, and let's say 9 months later it's worth I'm just making these numbers up, I can't remember, 370. Let's say 370, right? The lender, we're going to say, hey, we're going to lend you based on the lower of the sales price and the appraised value. So if it appraises at 370 and you're buying it for 350, we're taking the 350. So the 370 doesn't really help you on that initial purchase. However, down the road, it can make a huge difference on what you have when you rearrange it, refinance, that kind of stuff.
Definitely. I think we
Yeah.
were in our house for like a whole month.
So
And
this
we refinanced.
I know.
We're like, let's refinance our house. We just closed, but like we could do a cash out refinance. Like we had options.
And
Yeah.
this situation can really play into where if you had mortgage insurance because you had zero down on your home, and now all of a sudden your equity is clear up here when you move in, you can refinance off that mortgage insurance, correct?
Correct. You can refinance and get rid of your mortgage insurance, or you can, if you're not, the magic number to eliminate mortgage insurance is 80% of the value. That's the magic number on a refinance. And let's say you bought the house with nothing down, or 5% or 3% down, a minimal down payment. So you owe, let's say, 95% of the sales price, right?
Right.
And some time goes by, and now the house has gained value, and now you're at maybe you're not at 80% of value, maybe you're at 85%. So you're in mortgage insurance land still, but it's greatly reduced. It's about half or even a third the cost
Oh, you
of
can
what
do
your
that.
95% loan is. Yeah, we do that all the time.
Okay.
Awesome.
So it
Yeah.
reduces that mortgage insurance amount as well.
Yeah, the amount is, it depends, the mortgage insurance amount depends on your credit score and the loan to value, the equity in the property. Yeah,
So
we can play
let me
that.
kind of explain the watered down version of my understanding or how I explain mortgage insurance in general. So mortgage insurance, the whole purpose of that is to protect the lender, correct?
Correct. Yep.
And so if I'm putting 20% down and I decide to move to Mexico and never talk to anyone, there's equity that the lender has access to in order to recoup their costs.
Correct.
If everything goes to crap. On the flip side, if I'm putting zero down, the mortgage lender is at higher risk because they don't have anything to use. And hence we have mortgage insurance in the sense of each month I'm paying $100, $200, $300, whatever that percentage amount is, which you said is based off of my credit score and other factors, right? To be able to protect the lender. So that payment isn't going towards my mortgage. It's not going towards anything. It's pretty much a fee at that point, which is covering the lender's risk, correct?
Correct. Yeah, it's insurance, and the lender is the beneficiary. In other words, the lender benefits if the insurance policy has to be used. So it's just like insurance on your house. Is when your house burns down, your house they'll rebuild. They'll cover the cost of rebuilding the house, but you're not really gaining anything. But as far as insuring against losing a job or unable to make your payment, it has nothing to do with that. It doesn't help you at all. Yeah, you're right.
Yes.
So that's why we try to get out of it as soon as we can.
Exactly. So with our market right now, with all of the craziness, if someone's like thinking like 6 months into the future, let's say they're under contract to build and it's done in 6 months, whatever, would you say that comfortably with things where they're going? Because in my opinion, on the real estate side, things I feel like for 2021 aren't going to fall off the face of the earth. I mean, obviously, we don't know. We could have an earthquake. There's outside acts of God, whatever that could happen. But in general, things are still going with an upward trajectory. In my personal opinion, I feel like they're going to start to slow. We've had COVID, we've had all of the election, all of different things and kind of this chaos, right? And so it's going to not rapidly increase or decrease. I think we're just going to like play it steady for a bit. What is it on like the mortgage side?
Yeah, I think you're right. In fact, I'd go a step further even and say, listen, when you look at your affordability or your comfortable payment and down payment wise and all that stuff, don't plan on, I'll do this now. It's going to be a hardship for us. We're going to squeeze into this house. Payment's too high, really, but 6 months from now we'll refinance and all will be well. And that's kind of a dangerous.
I'm like, I wouldn't be telling anybody that right now.
We don't want
exactly. And to tell you the truth, a year ago, I wouldn't have told anybody that either. Turns out I should have probably, right? But you just don't.
I guess it's kind of like an added perk, but not something that you're banking on.
Correct. Don't bank on a refinance, especially also another part of the refinancing thing is rates right now, in case you haven't noticed, are super, super low.
Yes.
Crazy low. Where are they going to go? Our projections are they're not going to go up much for the next year or so because we got, poopy economy. So as long as the economy stays kind of lackluster, that's going to help interest rates. So that's kind of where we're thinking. So, but and you think, well, I'm going to refinance, drop my rate. You're not going to. I doubt you'll ever refinance and drop your rate. I don't see how that's possible. It's possible, but not. It's very, very unlikely.
The lowest low.
Yeah, you're in the 2 point whatever it is, 7, 6. I mean, it's just crazy. So for rates to go down lower than that, you'd have to be something pretty catastrophic, and we don't expect. Yeah. So, so in affordability, the way I tell people is just if you make sure it's comfortable as is. Don't think about refinancing in the future because it may not come to fruition. May not, but it could.
So on that note, we had a question come in on Facebook, kind of sidebar.
Yeah.
Christine wants to know how much has the Bluffdale area gone up in yearly value the last year or so, and what is projected in the next coming years?
So I can probably answer that. With Bluffdale, that's where I'm living right now. I can tell you that at the beginning of the year, we had homes listing around the 530, 540 mark. And this is kind of like you have different types of housing, right? So I'm just going to focus on one type.
Except for a single family.
And so for a single family home and even townhomes, all of these have like incrementally shifted up.
Right.
And so now if I go on the MLS, I'm looking at homes at like the 600s. And so that's within one calendar year. This year has kind of been unprecedented with so many factors. Real estate in general has literally been on fire. And so I feel like this year compared to any other is like straight up and down or like slightly tilted.
Yeah.
Whereas before it was like a slower increment. And so this year, especially, I feel like is an exception. It's definitely increased by margins that I don't think anyone could have predicted. Moving forward in the future, I feel like it'll still continue to progress, but at a lower fractional rate. What are your thoughts?
Yeah, I agree with you. I mean, I'm not sure what the official percentage is over the last year. It's not 2 or 3. It's more than that.
I believe the Salt Lake Board of Realtors recently issued out something that they are projecting an 8% increase for Salt Lake County over the next year.
8%. And what did they? You remember what last year was? It's more than 8. More than 8 last 12 months. It's got to be more than 8%.
Yeah.
We'll
it's a lot.
Homework and throw it in
for sure.
We'll fill the report in. We're not sure. Yeah, but it's crazy. Yeah, and an appreciation like that. And I'm old enough to remember back in the 90s, even when in the mid 90s, the property value started to really pop here around in Utah as well. Really started to increase, and the assumption was for many years. In fact, on Wall Street, in fact, this is one of the reasons of the mortgage meltdown. Not to digress too much, but the assumption was an 8% appreciation of real estate nationwide forever, which is unsustainable. So we're kind of in that same situation on a local scale as far as that goes. But yeah, 8% would be pretty awesome.
Hey, I'll take 8%.
And so thinking of that question as well, Christine had a follow-up question. Did it differ significantly for a townhome versus single family, or are they both kind of on the same projection?
That's a great question. Tanisha, what do you say?
I feel like it's kind of apples to apples in the sense of if you're buying a townhome, the cost for that townhome is here versus a single family home in the same exact area, the price is here, right? Yeah. So what you're investing in it is going to be different, but the incremental changes are going to be the same. So for example, if I'm building in an area and for example, there's a lot of LDS temples coming in, it's known for like that area to have a positive growth after that because things outside factors are implementing it versus if someone were to build a Walmart, it's shown that areas right around that Walmart tend to suffer. And so I don't think it's more so of like, okay, am I going to get a higher return with a single family versus a townhome because your investment levels are different? Yeah. But it's more of, okay, what areas, what pockets are going to have a higher percentage than others? Because even if I look at Bluffdale as a whole, there's different pockets within Bluffdale and any city that those percentages are going to differentiate.
Right.
So right here in our Independence at the Point community, we're about apple to apple on those two.
For sure.
Yeah.
Perfect.
Thank you, Christine. Keep asking questions. So just to kind of recap where we've come from, we've talked about what goes into getting pre-qualified in the sense of your affordability. We've learned that it doesn't include your personal spending, and that's why the recommendation is not always to purchase what you're pre-approved for, but more of affordability is more of your own personal comfort level and so your lifestyle, what that looks like. So I guess let's go ahead and pivot and jump into the next part, which is this mortgage payment breakdown, right? Is that where we're at?
Breakdown. So the way it works is this is just kind of a general case, and we use those numbers above the 80,000 per year income, right? 80,000 per year income. and no down payment. So we're kind of mixing a couple of programs together, but you'll get the idea. So at that particular interest rate that we have up above, the total payment on a house, if you borrowed $530,000 roughly, let me change that a little. That's still too high. Let me drop that down a little bit. Let me do this, 60, 70. I want to get your loan down. There we go. I'm going to lower the loan amount a little bit. So let's say in this particular case, we've gone over your numbers and we realize that the maximum, what we call the debt to income ratio we talked about earlier, which is the percentage of your gross monthly income that we can use. You can spend about 43% of that usually on all of your debt payments. Okay. So Tanisha goes out and buys that big truck that she's always dreamt of for $75,000 and ends up with $1,000 payment on that truck, right?
That's the one I'm getting.
Yeah, it's a fancy, it's got the whole everything, right? The diesel, the whole thing.
Okay.
And if you remember, so if you have down here, your payment on the mortgage on a $457,000 mortgage is about $2,200. So there's your total payment there. This is how it's broken down. And if you've heard the term PITI, use that sometimes. It's principal, interest, taxes, and insurances actually. So you have your principal and interest right here, 1866. Taxes, that's your property.
I want to like break it down even smaller. So principal means that it's going to your house. It's paying down that total amount. Right. And interest is your interest payment. That's not going towards the house. That's just paying your interest.
Correct.
So that's your P and your I.
That's your P and your I. Your T is your taxes, and that's your property taxes. We look at your property taxes for the county, what the county charges you, and we divide that by 12, and that's your tax right there. It's not your income taxes, it's not anything like that. It's just property taxes. Even when you pay your house off, you still have to pay those property taxes.
Right.
Yes, which is more than the taxes on Tanisha's new $80,000 truck.
It was worth it.
Yeah. Then the next thing, insurance, homeowners insurance. This is the insurance that every lender requires that you have, and I presume you would have it anyway. It insures your home against fire, theft, liability, water damage, that kind of stuff.
So that's your next T and I, right?
That's the T and the I, yeah. And you use your own insurance agent, Farmers, State Farm, whoever you want to use, right? And we take your premium that you have, and we just divide that by 12. Now the mortgage insurance, that's MI, mortgage insurance. That's the mortgage insurance we're talking about. That is a fee that you pay for the privilege of putting less than 20% down.
So if you were to put 20% down on that top number, that MI would now go away. That mortgage insurance would be
It'd be zero. Yeah. 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 And one thing about mortgage insurance, you can see where it says months until MI can be removed. That's when it will automatically drop off.
If you did not refinance.
But you have a but. I got two buts. Ready for this one? Some loans, the mortgage insurance never drops off.
Really?
HA, it's on for life. USDA
or HSA?
FHA. What's HSA?
That's health savings account.
That's a health savings. Mine is so empty. I don't even know what it is. So yeah. So and that that's more of a specific thing, but you get the idea. There's how your payment is made up.
So you need to know what type of loan you're getting and not make assumptions of like, oh, I've heard these random things and they'll magically happen to me. Because if you are in an FHA loan, your mortgage insurance will never be removed unless if you refinance the entire loan.
Yep.
Versus if I'm in a conventional loan, when I naturally hit 20%, it will drop off. But you can contact earlier during different points to get it reduced, or there's different options for me.
Yeah. So in fact, if anyone listening, you may actually be in this situation. Since your home may have appreciated a lot and you've got a pretty good interest rate, refinancing may not be a great idea. Because I really hate to have people refinance when it's not a good idea. That's not a good idea. So a lot of times you can actually dispute your equity, or you can contact your loan servicer and say, hey, you know what? I've had this house for 3 years. I've been paying on it. I put 5% down when I bought it. The way we look at it, I talked to Tanisha. She did a CMA, what is it, comparative market analysis report. And she said, hey, my house has gone up from 350 to 410,000. And my balance is, I'm pulling numbers out of the air here. So you say 420, I owe 410 or something like that. and you really, or 310,000. So maybe you're at a point now where you're at 80%. The months until MI can be removed is a calculation. It actually stays on there and it falls off when your natural amortization, meaning when your loan balance is paid from where you started down to 78% of what you bought the house for. Not 80, it's actually 78. And then it automatically by law, it drops off. But before that, you say, gosh, I'm at 20% equity right now. We owe, for my calculations, we're at 79% of the value. So what you do is you contract your servicer, who you're making payments to, and just say, hey, I think I'm at 20%. I want to do the thing. I want to get rid of my mortgage insurance. They'll say, here's our process. Here's our thing. And if they don't say that, you need to hang up and call back later.
You'll get a different rep. Just keep
You'll
going.
get a different rep. If they don't say, if you say, look, I want to do the thing, and they say, excuse me, you say, oh, I'm sorry, I'm going to have to call back later. It's kind of frustrating, but it's important to know the lingo. So anyway, you say, they'll send you a form, you fill out the form, and they usually charge you a couple $100 fee, and they'll do either an appraisal or they'll hire a real estate agent to do a Tunisia CMA report. Now you can't pick the agent, they will, but they'll come in and say, okay, your house is worth $411. Awesome. Then you're at a position where your loan is less than 80% of the value, and they'll just drop it.
Yeah, and I do want to say, like, with brick by brick real estate, like, we do that. Like, we are never, like, in that case, if you were to petition that, get it approved, there's no commissions, there's no payouts, there's no added benefit, but like, we don't care. Like, we want to be able to build relationships, help people. So that way, when you get to the point when you do need to sell or you do need to have these aspects, don't let that be an excuse to not talk to us. Like, we want to be able to help. And like you said, like, you want to have a CMA before you go into that situation to see, hey, is this an option for me? We want to be able to provide the information, the value, and like, even that alone, just knowing, hey, that's a thing, maybe I should see if that would work for us. Like, contact us, let us know. We want to help you. We don't have to sell your house. We don't have to buy you a new one. Like, reach out. I think
that's a great offer though, because it's hard, because I don't mean to break, and now let's just say it. When your neighbor sells their home, right? And you say, hey neighbor, sorry to see you go. We love you. What did you sell your house for? And they say, $475. Can you believe that? And then you call Tanisha and say, hey Tanisha, that great neighbor of mine sold their house for $475, and Tanisha looks it up, and it actually was $450.
I'm like,
I tell you, I don't know why people do that. Yeah, it's just a flaw of human nature, I think. But, that is a fantastic offer to get a free CMA to see where you're at. That's tremendous.
What's our question? Someone was asking.
Yeah, so right now we're talking about this mortgage scenario, like this is your primary residence, correct? So we do have a question coming in from Amberly, and she's always wondered about second homes, and specifically like a land with cabin on it, and what kind of those breakdowns are going to look like for those types of properties.
Oh, I love second homes. Cabin means to me relaxation.
Yes. And me and my husband are currently looking in the same situation, so I'm very interested to hear this as well.
Yeah, so it's a great question. Second home, or they call them second/vacation home, is what it is. And that designation means that you're going to occupy the property part-time.
Okay.
The agencies, which is the Fannie Mae, the rule-making people, the lenders say, look, there's no specific number of days you have to stay in it, for as far as we're concerned, and you can even rent it out on a part-time basis, like Airbnb. We don't care.
As long as it's not strictly an investment property to rent out.
Yeah. So, but if your primary purpose is as a vacation home, then no problem. And that's important, because the interest rates and terms on a vacation home are really similar to owner occupied.
Oh, wow.
So let's say, for example, I live here in Bluffdale, and I want to buy a cabin down in Fairview, Mount Pleasant area down there. I'm just pulling areas out of the air, or St. George, or Richfield, or Salina, or some cool place that's far enough away to be obviously far enough from your house. So you can't, if you're in Bluffdale, Tunisia, which is, for those of you, it's South Salt Lake County, and you say, hey, I'm going to buy a second home in Provo, Utah, right? Okay. Utah County, 20 minutes away, that's probably not going to fly.
Got it.
Meaning that they're going to say, well, we don't really think you're just going to, either you and your wife are fighting a lot, or it's really
My
not very
husband needs
feasible.
his own.
It's my vacation from my husband home.
Yeah. That's actually a funny story, but I'll tell you that later. No, anyway.
We'll get there later.
So if you're talking Fairview, Mount Pleasant, St. George, Cedar City, that's a couple hours away, hour away, then that's believable. It's especially, and you mentioned a cabin, especially a cabin type of property, Duck Creek, that type of stuff, where I buy that. I mean, we look at it and say, well, of course it's a vacation home. You're not going to live there and commute from Fairview to Salt Lake City where you work, that type of thing.
So before we deep dive too far, because I feel like I want to address in general that what we're talking about with a mortgage breakdown is a traditional first-time primary resident home. Factors change if we're looking at vacation rentals, investment properties, and there's different things based off of the location, the reasoning, and factors that are going to play into what you can and can't do.
Correct.
And so I feel like let's do like a follow-up session just like this and talk about and deep dive into what those options look like, what you can do, the flexibility, so we can really give it the time it deserves.
Okay.
And those who are here for the main mortgage payment, because I feel like we're about halfway through, they can be aware of like, oh, there are different types, which we've addressed before, and let's deep dive another time into what those look like and have like what investment second property video.
Yeah, we can look at that. I'll give you a quick teaser. A quick teaser is second homes interest rates are the same.
Okay.
Really?
The rates are the same. Mortgage insurance is the same. The difference is your down payment's a little higher. That's it. And then when you start talking about cabins, what's that?
Is there a set down payment amount for properties?
10%.
10%.
On a second home.
But on the flip side, I feel like there's always like a but or a hey, by the way. So before we completely close this book, for example, my husband and I, we wanted to have an investment property, and we're like, we want to own 7 properties by the time we retire, or whatever that goal was. Okay. And having that big down payment every single time just wasn't in the cards for us. So I remember working with Brian, and we would buy a home as our primary residence. We would flip it into a duplex, do the top and the bottom. We would live there for a year, and then we would buy another primary home under the circumstances, and we would rent that out. I mean, there's different ways where you can find pockets that work for your exact situation. And that way I could then rent. I had a 1-year rental agreement on my old house. That rental agreement was actually more than what the mortgage was. So I could use a fraction of that towards my affordability. I could buy a new home as not a first-time home buyer, but as my primary residence and take advantage of those and live there. And that would be our primary home. And so there's different ways to meet your goals. And so again, just going back to let's talk. If you have a goal, let us know. There's multiple options that we can do that'll fit your unique needs. Right now, we're talking about primary mortgage payments, and we can jump into how that can work in different scenarios. But for now, you have options, and there's your
yeah, definitely. And we'll want to talk to you about the cabin situation too, because there are cabins and there are cabins. like no electricity. I'm gonna live in bear skins and
like a real cabin.
That's a cabin. Yeah. But we can talk about that later. Okay. So as far as we went through the payment, how the payment's made up.
Yes.
And of course, the payment is simply a function of the interest rate and the amount you borrow. And the rate's not the big thing. The big people think, well, if I get an 1/8% lower in rate or higher in rate, that's going to affect my payment a ton. It's not really that much. What really affects the payment is how much you're borrowing.
Okay.
That's really the big factor. So anyway, we go down here and you can see the payment breakdown in kind of a pie chart there. But the budget ranges. Now, what this is trying to show is if you think of it in terms of percentages, we the lender are going to say, look, you think you can afford more than 43, sometimes 45% of your income to be your payment, that's great, but we're not going to lend it to you. So
we don't believe you.
We're going to cut you off at 40. It's really 45 sometimes. It depends on the type of loan. But so that means that if you're figuring, let's say the minimum is you're saying, well, on the more really conservative side might be 26% of my income can be my debt payments, right? up to 43, and that low to high range right there, and see that within, so you could borrow anywhere from 235, 500 up to 257 or 457.
A huge discrepancy. That's like double.
Correct.
Like, holy crap.
Yes, and that's why I hate mortgage calculators, because there's your picture, which is just, and then you look at this and think, well, okay, the difference between 235 and 450 is not even the same property.
No.
So what we want to do in that scenario, when we pull this for someone and say, hey, this is your range, we want to find out, where are you comfortable within that range?
Correct. Yeah, and that's a 20-minute phone call with me. So that's the best way to do it. But that gives you an idea. And most people really are kind of in the middle of that usually.
We have a question. Yes. So with that 20-minute phone call, I just want to paint the picture that like there's no reason to be afraid to have that phone call. A lot of people I feel like are like, oh, I don't want them to touch my credit. Like I don't want them to do credit pull. Answer this question. Do you have to do official pre-qualification to have this conversation?
No. In fact, the first conversation, I don't pull credit.
Okay, so that was going to be my next question is, do you have to pull your credit in order to have this conversation? No.
No.
And so let's start having the conversations. I feel like 2020 has been a roller coaster. If it's a dream of yours to buy a home, 2021, like this is our year, we can have these conversations. You don't have to pull your credit. You don't have to do anything invasive. You don't have to sign contracts and get committed. Right. Let's just figure out where you are, where you want to be, and connect the dots together.
Yeah, in fact, I'll give you a statistic. And I looked this up a couple months ago. I think I'm pretty close.
Made this up, or you looked it up?
Okay. No, I actually looked it up. It's kind of semi-anecdotal with a little bit of fact behind it, a little bit. Okay. The average time from this first call with someone who you want to buy a house, especially first-time home buyers, the average time between that and them actually making an offer on a house is about 3 months.
I would say that's pretty spot on.
Yeah.
And even within that statistic, like if you're not ready in 3 months, we're not going anywhere. We're here for the long haul with you. So if you talk to Brian and things just aren't in the cards right now, we'll stick it through it with you and we'll help you out every step of the way.
I feel like some of our clients have like 3-year plans, 5-year plans of like, we need to add a layer of credit repair, because this isn't something that we addressed here. But with those programs that you were mentioning, there is a requirement of credit score. And so it might be a matter of like, yes, I could buy a house right here at 235, but if I can get my credit repaired here, it opens up these zero down, these opportunities for me to be able to be in a much better spot. It's going to take me some time to do that. But like, that's what these conversations are for, is to pinpoint, okay, all of these factors exist, but which one holds the most weight that I need to invest my time into right now, whether that's saving for a down payment, working on your credit score. There's so many different areas. And I think a lot of people just get stuck on the down payment side of, okay, until I have 20% or 5% or whatever, I can't talk. And that's so not true, because there's so many other factors that exist that all you need to do is pick up the phone, let's have a conversation, and we'll help teach you and show you what your options are. And above that, create a roadmap of, okay, these are actually what we need to do in order to accomplish it.
Yep. Exactly right. And a lot of times you'd be surprised how with credit, you talk about credit repair, the vast majority of the credit work we do are minor tweaks, pretty minor. Like for example, if your credit score maybe is 690, that's an okay score. It's a good score. It's not a great score. And most people that I talk to, the difference between a 690 and a 720 credit score can really translate into a lower payment. I mean, it can be hundreds of dollars.
And I feel like
usually.
Oh, go ahead. Sorry.
I was gonna say it really doesn't take usually a ton of work.
Yeah.
No.
I think that goes into knowing how and what to do. So it's like, okay, if I know I have 5 credit cards or these issues, it's just like, do I just randomly reach and pick one and say, okay, this one I'm working on? Like there's a reasoning behind it of figuring, okay, what are those minor tweaks of like, I don't have to consolidate all 5 and pay them off tomorrow to buy a house. Right. I just need to know which ones I need to tweak, what I need to do, what steps, and that's what we're here for too.
Yeah, and I can give you a report actually that tells you exactly if you need to pay this credit card down from $1,120 down to $312. I mean, it's that specific. Credit scoring is nuts. It's just.
If I have $100 and I put it towards one, that might not be in my best interest. I might need 75 cents here, 450 here, you know, like fractioning that up. But if you don't have a clue as to which one's best first, like someone else does, and we can help you.
And sometimes you have to increase
$100, we can help you know where to put it to make it, to get you incrementally closer to what that goal looks like.
Correct. Exactly right. And sometimes in some weird cases, we have to actually say, hey, you know that Capital One card that has a zero balance on it? I need you to go buy gas for 18 bucks.
Spend some money on it, please.
And that will raise your score 8 points and then get you over 720 and your rate's a 0.25% lower. I mean, it's that simple. It's really weird. But
so
we can do all of it.
Scenario of paying down credit and everything, a lot of people have these questions. Let's plan to make a video just on this. So we can talk more to this situation. Let's go ahead and feed through this a little bit more and wrap this up for today. And then I would love to jump to credit repair another time.
We'll do credit repair and investment opportunities outside of your primary home for sure.
And we could even do one on property like cabins.
Yes,
investment in cabins
for sure.
That's a big thing.
Watching, if you're wondering this and you want to be our guinea pig, like let's talk, because we can use your numbers and we can go through the experience. And then those who also want to have the same experience too, like after each one of these calls, we put this sheet out there for you to be able to read and break down. We can create this exact same thing. Like Brian, hover over these things, click these buttons. All of these are unique, they're customizable, and it can be exactly for like what you need. So this can be your experience too.
And we did actually have a question to that. You know, in this scenario, we are working through a zero down payment on this payment breakdown right here. If someone is in a space where, let's say they have $80,000, $90,000 to put down on this home, that totally changes that payment up, correct?
Yes. Yeah, it does two things. It'll drop your loan amount, of course, you're putting more down, but it'll eliminate that mortgage insurance.
Mm-hmm. How many times, Brian, have I brought a client to you who has money to pay down to where that's not actually the best for them to do?
Yeah.
Like, I feel like it's surprising to people. Like, I've worked really hard and we're like, great, based off of what your ultimate goals are. Because I feel like sometimes it's like the house is the end goal. And I don't like to look at it that way. I like to look past the house and say, okay, after we have a house as a part of our portfolio, if this is where we want to be, taking that money on the down payment, because we've run numbers, we've run interest rates, figuring out the different programs that are available. Sometimes it's in their best interest to be like, you know what, pay off your cars, pay off your debt, or invest that, go put it in the stock market, find other places, because we're looking at everything from like a whole picture versus, okay, we're only looking at tunnel vision of the house. And so I think that might be surprise people in the sense of sometimes when you have, let's say I have $100,000 equity I could pull out of my house, maybe I only want to put 20% down, take that extra money and go get that cabin or that rental or an investment property, diversify my retirement portfolio. So I think there's not, if you have an all or nothing mentality of like, I have all this money, it needs to go in this one place, or I have 5 credit cards, I need to pay them all off. Like, you're just making your life really difficult. It doesn't need to be that way. There's more opportunities to take either one opportunity and break it up into multiple, or having a problem that has multiple facets of it and just tweaking the small ones in order to continue your progression.
Yeah. Yeah. And we look at things like that. Yeah, you're right. A lot of people, we end up just saying, look, you got some debt here. Let's get rid of that debt. Because getting out of, a lot of people have a goal, maybe pay the house off in 12 years, for example, right? And the secret of the great, don't tell anybody, but the great secret to getting out of debt is all about cash flow. Cash flow. That's everything. Because the more cash flow you have, meaning the more money you have left over after your outflows or your income, right? The more money you have left over after paying your obligations that you can apply to debt or invest or buy what other property, whatever, the more of that you have, the faster you can get rid of that debt.
Absolutely. And it's a mind game. It's uncomfortable. Even for myself, we have a financial planner.
That's right.
Don't pay this off. When you get money, we're going to put it here. And in my mind, I'm like, I really want to just get rid of that thing that's like irritating me, but it's like, don't touch it because that interest rate is this and this interest rate is that. And you can make like, there's so many different factors, and I'm grateful that there's other people that are smarter than me, but it's more of just like, even if you're doing everything right, or if you're struggling, like no matter what point you're at, it's uncomfortable. It's a new way of thinking, but find someone that you're able to trust and that can look at that overall game plan. So that way, and now we're way off topic because we're supposed to be talking about affordability.
I feel like
but in general,
it's related to.
It is related to. So let's scroll down, and I want to see what this last little bottom part is.
So that's pretty much it. Yeah, that's pretty much it. This is just the kind of a summary of it, of
Okay.
what the input we use. So the 70,000 income, maybe this person has $250 per month other obligations. That would be a $250 car payment or a $50 student loan and whatever.
That main number up there, or that
And
range.
that affects all the numbers above. So that's just more of a summary
Okay.
of what it would be. So yeah, that's pretty much it. And like, there's more this is really specialized. This is kind of a general case for kind of Joe Schmo, some guy, whatever. But we really want to get very specific and be an advisor for you, because that's what it comes down to. I mean, I have a financial advisor myself, and it allows it, like Tanisha, you mentioned, you want somebody that can look at it from the outside, because debt's emotional. I mean, really, especially a house.
Right.
It's an emotional thing. It's where you live, right? And you have these things in the back, oh, you really need to pay this off. I really need to pay this off. And you really don't know how. Again,
Definitely.
it goes on.
And Brian, we will do this one-on-one with any of our clients that we send to you. And
Correct.
you do this breakdown for them with their real life numbers.
Yep. We do that.
So I feel like the main takeaway of affordability and everything, just kind of like wrapping it up and tying a bow on it, is one, you don't have to have a huge down payment. I feel like that's one of the biggest misconceptions. Yeah. Two, affordability, just because you can afford something doesn't mean that's where you should be. Really, I don't want someone to go to a calculator and see that 457 and go start shopping for homes at 457. Right. I think the main thing is you need to have a conversation. You need to understand the pieces. Yes, principal, interest, taxes, interest, PTI, whatever, those things exist. That's going to be the same, but that's only one small part of an overall equation of, I can understand the numbers, know what I can afford, but really let's figure out where your comfort zone is within that range. And from there, go and get a house, and we can surprise you with what your options are if you're thinking that you have to have 20% down or something along those lines.
Yep.
And another big takeaway from this too is we can do almost all of this without ever pulling your credit report.
Yes.
Correct. Yep.
Okay.
Easy peasy.
Thank you. Thank you. I'm pulling up here, if my thing will load, what we have on the calendar for next month. So every single month we're getting together. We're talking about things. Our next month for December, we're going to be talking about cost of waiting. That'll be the 1st of December. So keep in mind and look out for that. And in between, or at some point, thank you for giving us your questions, your feedback. We're going to do another one of these. We'll talk about credit repair, kind of all the different options there. And then we can do one on investments, cabins, and second mortgages and things of that nature.
Sounds good.
Thanks, Brian.
All right, good. Thank you, guys.
Thanks. See ya.
Okay.
See you later.
All right. Bye. Oh no.
How do I cut this?
I left you in charge.
We're going to go over credit repair right now.
You have to make me the presenter. Give it back.
I can see.
The first video, we had 2 minutes of like, let's pretend.
Yeah, everyone watching, just look at the bright side. This could have been at the beginning.
I know. Now it's at the end.
Where's the thing?
At this point, shut it down. Just hit the leave.
Okay, stop sharing your screen. You gotta start.
I don't know why I can't find my little menu.
Okay, move the pictures of us out of the way, because usually they.
There it is. Oh yes.
I learned from last time. So you'll stop sharing the screen. There we go. Okay. That's
yes.
Wait, we're still live.
Oh, I was gloating too soon.
Okay. Next step, go over us.
And Ryan and end.
Presenter. You're gonna give it back to us.
We can just hit leave.
You guys have a different screen than I do.
Kick us off, and we'll keep it going because Brian said it. I don't have any confidence in you ending this on your own.
More.
This is like
kick more and then make us the host.
Oh, I did it.
Okay.
We're gonna create this and put it into like a bloopers.
Yes. Okay. Now for real. Goodbye, everyone.
Goodbye.